Joining us now is Chris Harvey, Wells Fargo Securities head of U.S. equities strategy. Chris, have we seen a near-term top in U.S. Treasury yields around 1.75% on the 10-year? And if so, what does that mean for equities at this point?
So I think we have. So I do a lot of marketing with our head of rates, and we talk almost on a daily basis. And what he thinks is 175 is a near-term top. He does think that we get to 2%, maybe by the summertime. And what that means to equities is, as rates start to come down, you'll see a little bit more bid to your tech, to your growth companies. They've been significantly oversold for the last couple of days, last couple of weeks, and we're beginning to see a bounce. We think it's more of an opportunity to reposition because ultimately the economy gets stronger and rates do go higher. But if you want to talk about the near term, in the near term, we think you do cause a little bit of bid to tech and to growth because of the rallying treasuries.
We got the inflation data, the PCE, out Friday, Chris, and I think that's going to be really significant for the market to pay attention to. What I'm wondering, though, is I look at what is coming out of Washington in terms of the spending. Like, checks are going out for the current program, and we're already starting to talk about the next program. The infrastructure program is going to be over a very long period of time. The fiscal impulse is going to fade next year. We're front-running a lot of this story into this year. And I'm wondering at what point the equity market starts looking into next year and smelling that slowdown. And what does that mean?
All right, Guy, all great points, all great questions. And it's something that we talk about a lot. We think, to answer the question, we think probably by the summertime, because in the summertime, we're going to be talking about higher taxes. At some point, you need to pay the bill. In addition to that, the Fed's narrative will not change. The Fed will say we're going to be low for longer and longer and longer, but eventually the market's perception about the Fed is going to change, and the market will move before then. And so the second thing we're going to be talking about in the summertime is, when does the Fed become more hawkish, right? And if you get those two narratives together, that starts to put weight on equity prices, on risk prices. And what we're also beginning to see is we're seeing a real derating in your bond proxies and your low volatility. That creates an opportunity. So we think by the summertime, you need to start thinking about your next step and possibly pivoting to a more defensive type stance. So
is that picture you just painted for us, Chris, the reason why you have a 3850 on the S&P 500 target for year end?
We have a 3850 for a bunch of reasons. One, we're always more conservative. So last year at this time, we were not one of the people that were cutting our price target. We held on to our price target and we were telling people to buy. And so we never want to, there's more of a bias for us to be more conservative, because in times of stress, we don't want to capitulate, right? The other thing that we've been talking about is a rotation, a major rotation, and that's occurring, right? We're seeing that rotation from growth to value. We're seeing that rotation from large caps to small cap, and we thought that would weigh down the equity market. What we're surprised about, what's changed from the beginning of the year till now, is that the sweep in Georgia did cause the stimulus to be much bigger than we would have expected and occur much sooner. So much of our book, our small cap recommendations, our financial recommendations, our high COVID beta, our cyclicality has all worked, but it's worked even more than we thought. So it's not so much that's a bearish view. It's really, we don't like larger cap. We're really positive on more your cyclicality. So I wouldn't view it as that. I would view it as us being a little bit more conservative.
Chris, the Russell 2000 is up by 14% year to date, which is just, as you say, absolutely eye-watering, and the rate of change has been absolutely blistering. But you talked about this pivot a moment ago, summertime, to being more defensive. What does that mean?
Yeah, so we're already beginning that pivot. So last year, about 11 months ago, we upgraded small caps. It's had a tremendous run over the last 12 months and year to date. Recently, we moved from a small cap stance to a mid cap stance. Mid caps have really underperformed small caps, and we think you want to start finally moving up that capitalization. With regard to what that shift looks like to a more defensive stance in the summertime, we can possibly want to get more exposure or anchor the portfolio with your bond proxies, your utilities, your staples, your low volatility funds, while still gaining or still holding on to some cyclicality. But eventually, those bond proxies are starting to look very attractive. And if those narratives we talked about do come to fruition, we think that could be a catalyst to start to see that derating and see a re-rating upwards.
Chris, I want to ask you about volatility. We're looking at around a 19 handle on the VIX today. Do you expect that to continue inching lower?
No, we think that the VIX should stay in and around this level. we can see spikes. We do expect to see spikes as we go forward, but we think the days of 10, 11, 12 VIX, we think those are over. We are in a higher volatility type of market. There is more stress in the market, and we should see bigger spikes. But for the meantime, we think it should be relatively benign, and in around the high teens, low 20s seems about right to us.